Hi, I'm Art Bergeron, and welcome to this Bergeron Briefs, which is talking specifically about dealing with tax issues regarding your tax-deferred funds. As I often tell folks when I'm meeting with them, one of the things I love about being at Myrick O'Connell is there are 70 of us. I get to do what I love, therefore, we all get to do what we love. I like elder law, taxes, not so much. My friend Alan Falk is here. Alan, because that's all he does. And he loves this stuff. He just loves it. You talk to him about it, he gets all excited. So he's even taken some time off. Actually, right now, you may not be seeing this. Who knows when you'll be seeing this? But at the middle of tax season. But he actually took some time off just to talk to us. So, Alan, thank you very much for coming on.
Thank you, Arthur, for having me. And yes, it is almost the end of tax season, which is the good news and the bad news.
So can you just, once again, for the benefit of our viewers, can you tell them how you ended up getting here, despite the fact that you're like a tax guy?
Yeah. Well, so I've always done tax. I've worked for accounting firms for probably the first 18 years of my practice. I'm a CPA as well. And the opportunity came up to work at Myrick. I've always wanted to do trust and estate work in conjunction with tax. So it was a great opportunity, and I've been here for about 9 years. And my practice is focusing on trust and estates and tax, individuals, corporate, partnerships, trust and estates.
And so all of my tax trivia questions that I've ever answered to any of my clients really are just parroting Alan Falk. So, Alan, today I wanted to talk specifically about tax deferreds. I did doing a series of seminars called Elder Law 101 this year, and in one of them, I talked about tax planning regarding your tax deferred funds. Now, I put it in the context of Frank and Mary saying, okay, in this case, Frank and Mary are in their 60s, they're retired, so there's no more income coming in. Now they've got this pile of money. And I talked to them about whether for later on, for mass health related purposes, for elder law related purposes, they may want to be trying to shrink down the amount that they have in tax deferreds so that they can avoid kind of a big one-time hit on tax deferreds. And perhaps even so that they can do some estate planning, some gifting in order to deal with estate planning issues. But beyond that, as you know, whenever I get any question beyond that, I talk to you. So can you just talk to folks a little bit about maybe in these situations, what is the relationship between perhaps their 401k, now they're retiring, does that automatically turn into an IRA? What's a Roth? What isn't? And what kinds of strategies do you find yourself talking about with your tax clients regarding any of these issues?
Right. So, Arthur, I mean, we all work really hard during our lifetime to accumulate assets and have financial security, if you will, through our retirement accounts. The bad news is that tends to be taxable income when you withdraw it. The theory being, first of all, when you put into the 401k or your IRA, it's to grow tax deferred. And you also, in the right circumstances, will get a tax deduction going into it. So the thought is that one, it's going to allow you to invest more into your retirement account, and two, it's going to grow tax deferred, with the cost being when you go to retire, you're going to withdraw it and pay income tax on it. And you may or may not be at a lower tax rate. And I think that's when we'll get to a little bit, there's a potential planning opportunity there. So that's a 401k and that's an IRA. They tend to work fairly similar from an income tax perspective. When a lot of people retire, they'll roll out their 401k into an IRA. IRAs, you don't have to take what we call RMDs until into the 70s. They used to be 70 and a half, moved it to 72, and it's moving north of 72 now as well.
And what's that term, RMD?
RMD, so it's required minimum distributions. And when you have a what I'm going to call a traditional IRA, which is a non-Roth IRA. So it might have been a 401k that you rolled over into an IRA, or it might have been an IRA that you contribute to over the years. When you get to a certain age, you have to take out minimum distributions. Failure to take out those minimum distributions will result in penalties, and they're fairly severe penalties. So you want to make sure that you do take them out when you hit the appropriate ages. One of the other types of IRAs, which some of us are familiar with, are Roth IRAs. Roth IRAs have two benefits. One is it's not tax deferred if you leave it in the Roth for a long enough period of time, which is 5 years from when you open the Roth, and you're over 59 and a half, it will come out tax-free. The downside is the money going into the Roth is post-tax, i.e. you've already paid the income tax on the income, which is how it really differs from a traditional IRA or a 401k. The benefit, however, of a Roth is you also don't need to do RMDs. So you can have your Roth accumulate for your lifetime and leave it to your children or to your grandchildren, at which time they'll have to withdraw it over a fairly short period of time, no longer typically than 10 years. So that's the Roth IRA. One of the things, Arthur, that we see a lot of, as you know, in the practice is we have individuals who have accumulated fairly significant retirement accounts and they need to apply for Mass Health. So when they apply for Mass Health, one of the planning techniques is for them to withdraw the IRA and convert it into an annuity. The problem with that is, one, that's all income, typically. Two, because it's such a large number in a given year, you really ramp up your tax brackets. So you might go from a 10% tax bracket or a 20% tax bracket to a 37% tax bracket. So that's where one of the planning techniques come into that's really not discussed all that often. And that is, as you're going into retirement, and if this is an if, your income is dropping, or maybe you have large medical expenses in any given year, that you review your 401k if you still have one, or you review your IRA and see whether you can take a distribution. Because again, once you're over 59 and a half, you can take a distribution and you're not penalized. If you can take a distribution and either A, you're going to pay taxes at a lower rate, or B, it's entirely possible you may not pay any income tax because your deductions are significantly would able to offset the income that you're receiving from the IRA. Now that sort of flies in the face of what we tend to think of with a retirement account, and that is you want to leave them alone as long as possible and have them grow either tax-free in the case of a Roth or tax-deferred in the case of a traditional IRA or 401k. However, what you can do is when you take that distribution out, you can then contribute it, you can roll it, if you will, roll it into a Roth IRA, which means you'll recognize the income from the traditional, but the hope is that either you will have significant deductions to reduce that tax, or you'll be paying it at a lower rate. The benefit of that strategy is that should you need to withdraw the IRA, which is now in a Roth, and it's been in there for more than 5 years, it is going to come out tax-free, which you would then convert into the annuity.
Now, the last thing that you just said, I did not know. Well, there were many things that you say that I don't know, but I hadn't heard that in order for the money that goes in to the Roth to come back out tax-free, it has to have been in there for 5 years.
Well, the account has to have been opened for 5 years, the Roth, yes.
I see. And so in some ways, that kind of plays into the asset protection strategy that I'm talking to a lot of folks about. If you're a single person and there is kind of no, then let's see, if you're a single person and you are trying to qualify for Mass Health, then there is this 5-year look back period regarding any transfers that, oh no, this isn't going to work. I'm sorry, I was losing myself trying. I should never try to figure stuff out right off the bat when I'm talking to Alan Falk about taxes. So once again, going to the clients that I'm so often talking to, I'm talking typically to my friends Frank and Mary, who are trying to figure out how to protect each other. And I'll often tell them, I'll say, well, if one of you needs to qualify for Mass Health, then you can, while you're both alive, by simply shifting all your assets to the other spouse, and then having that other spouse purchase a very specific kind of annuity, a Medicaid qualifying annuity. But the problem with that strategy, as Alan had mentioned, is typically if you're moving all of the money, if you have Frank and Mary, and Frank is going into the nursing home and he's the one who had the big retirement account, before he can move his money to Mary, he has to make this big payment. So this notion of taking payments out over a prolonged period in order to reduce the taxes really makes sense. But I'm hearing Alan saying that that one of the ways to deal with this may be to put money into a Roth. But in that case, the money has to have been in the Roth for at least 5 years in order, when you take it out, for you to be taking it out tax-free. So it's even a greater incentive for folks to really be looking at this ahead of time, right?
Exactly, Arthur. And I think this is one of the planning techniques that you want to look at as early as possible and keep on your radar screen on an annual basis. Keeping in mind, what are your tax rates going to be in any given year? If your income drops significantly in 1 year, that may be the opportunity to convert into the Roth, or a portion of the traditional IRA into the Roth. Alternatively, like I said, and you and I, we have a lot of clients with large medical expenses. So if they've got the large medical expenses, it might be an opportunity to convert into the Roth, because if you don't use the deductions in any given year, they're lost. There's no carry forward for certain types of deductions, such as medical expenses. So it's really about timing, planning and timing.
And kind of re-looking at it every year. It's kind of like when I talk to folks about being on Medicare. And the nice thing about Medicare is that you want to be re-examining what your Medicare plan is every year, because your health may have changed. And one of the nice things about Medicare, you can change your plan every year looking forward, saying, well, if I think I'm going to have more trouble next year, maybe I want to be readjusting. I think you want to be thinking about this similarly regarding these accounts. And remember, the time to think about this typically is not April 15th or just before April 15th. It's just before December 31st, right? Because a lot of this movement, am I right that a lot of this movement has to happen before December 31st of each year?
It does. So I'm going to suggest to you that earlier in the year, the best to look at your situation and at least have a strategy to review, let's say maybe in October, what your tax situation is going to look like for the year, and whether it makes sense to basically accelerate income to take advantage of a lower tax bracket or deductions that you might not typically have had.
Now, Alan, one more trivia question before we go. It seems to me that one of the things, once again, that I, not doing taxes all the time, always talk about to folks is if you've got appreciated assets, typically we're talking about the home, but appreciated assets also like stock, you want to hold them until you die, typically, so that at the moment of your death, the so-called tax basis of those assets will jump to the date of death value, so that when your kids sell them, they're going to sell them capital gains tax-free. It seems to me that I remember you're saying, though, that there's something special about IRAs in this case.
Yes, and that's an excellent point, Arthur, and a lot of people don't realize this, but IRAs, traditional IRAs and 401ks, and even certain annuities, are what's called income in respect of a decedent. And what that means is that whomever receives the distributions will be subject to income tax. So there is no step up in basis in an IRA, in a 401k. Again, excluding the Roth IRAs, because although technically there's no step up in basis, you're not taxed when you take a distribution out. So that's a very good point. Sort of one of my pet peeves, and this, Arthur, is that when people say, well, gift, and they gift appreciated assets and they lose that step up in basis. That is not the case with traditional IRAs or 401ks. There's always going to be this income tax liability associated with it.
Right. So there's no special reason for estate tax or for capital gains tax purposes to be holding those assets. So once again, you may be wanting to distribute them early. So, Alan, thank you very much for this. I think, as you know, folks, I've been trying to do these kinds of Bergeron Brief presentations specifically to deal with targeted issues that I don't get into in detail in the seminar series. I hope this was helpful. If you've got any questions on any of this, please, you can give us a call anytime. You can give me a call at 508-860-1470, or Alan, what's the best number to reach you?
Arthur, my direct number is 508-929-1649.
Alan, go back to doing tax returns. Have a great day. Folks,
Thank
I
you,
hope
Arthur.
you enjoy this. I hope you enjoy this. Please let me know if you got any questions. Thank you.
A free 3-minute online chat can give us the personalized tips we need. Visit aceyourretirement.org.
Hi, I'm Art Bergeron, and welcome to this episode of Bergeron Briefs. These are the short presentations that supplement the seminars that I've been doing every month. And for my seminar regarding Frank and Mary, and therefore you, if you are in your 60s, we talked about the fact that that's the time where you really want to be thinking about whether you want to be going on Medicare versus staying on your own health insurance. That I told you, I said, the great expert on this is not me and is not your lawyer or your accountant. It's these people. Janice Long and Holly Richardson are both at the Hudson Senior Center. And I wanted to tell it, and they're both certified Shine counselors. I wanted them to start off in like a minute, talk a little bit about what that means, right? And this is what they're trained to be knowing how, and what they have the technical tools to be able to talk to you about. Holly and Janice, thank you so much. I know you know that you're taking out time from your day job here to be here. But could you just talk a little bit about what Shine is and the training that you get, and therefore the reason why every senior should know you folks.
You want to go first, Holly?
Okay. So SHINE stands for Serving the Health Insurance Needs of Everyone on Medicare. So it's not just seniors. It could be people who are under age 65, but they've been deemed disabled by Social Security. And so now they're eligible for Medicare based on their disability status. So what we do is we go over their options for Medicare, compare pricing, and see what would be the best coverage for them based on their needs. We also can compare it to what they're getting in terms of their employer plan, and just comparing at least the price of what they'd be getting. If you have a high deductible on your insurance plan at work, you have to pay a certain amount of money before you even get any coverage compared to what Medicare might be. You might be better off going on to Medicare as opposed to staying on your employer plan. But we can predict whether or not people are going to go into the donut hole with their prescriptions. And we can also screen them for any financial assistance programs that might be offered that they're eligible for through state and federal programs.
So they know a ton of stuff, and their goal when you walk in the door is not to just answer your question. They're genuinely, they do these jobs because they want to be talking to seniors. They like seniors, right? They want, if you walk in thinking you have this issue, they're going to also tell you, well, you may want to think about these other issues. You may be eligible for these other things. It's really, really important. So as it relates, Janice, no, please.
Most of the time when people come in, Medicare is so confusing. They just need somebody to help them, to guide them through that Medicare maze. It's just so confusing.
And by the way, Janice Long is the person who helped my wife and I through this Medicare maze, because we went in thinking that we really wanted to qualify for Medicare because, the cost is very low and blah, 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 versus, even though I'm still working, but it turned out that wasn't the best answer, right? And so we haven't yet, even though we're on Social Security. So could the two of you just kind of talk to those kinds of issues? Because you see a lot of people, and so you've seen different kinds of situations. Can you just kind of talk to situations where you're talking to people who and advising them, and sometimes saying, oh no, Medicare is really the right thing for you, and sometimes it really isn't. And Holly, I just want to go back to your example. I as a person who knows nothing about this stuff would say, well, I'm working and I'm on a group plan, but I know Medicare, that the costs are going to be really low, and therefore I should just be going to Medicare. And I think that's an assumption that a lot of people make, right? Mm-hmm. So can you just kind of talk that out in terms of how they should think about the numbers and what the options are.
So
and
everyone
Ian,
assumes that Medicare is the same price for everyone, and that is not the case. If you are in a higher income bracket, you could be potentially assessed a higher monthly premium for Medicare Part B, as well as a Part D adjustment for your prescriptions. So it might be the standard premium for someone else, but if you have a higher income, then you could be paying a couple $100 more for just your baseline Part B premium price. And so that can really affect it. Not only that, but your prescription prices can be a complete game changer as well. You know, if you're on really expensive medications, you're on specialty medications. Sometimes people are on manufacturing programs too, where they get assistance. A lot of times when you make that transition to a federal program like Medicare, you're no longer eligible for the manufacturing programs because you can't be on a federal program and have that.
Holly, can you just speak to what a manufacturing program means?
So that would be, you know, sometimes the manufacturer of the actual medication has financial assistance programs, or sometimes there's foundations that provide monetary assistance for people with their drug costs if they are, you know, having difficulties paying for their prescription. So that could potentially be affected. But not only that, just the price of the medications can drastically change the outcome of people's decisions. I've had clients that they're better off financially going on to Medicare based on the health insurance aspect, but their medication costs would be hundreds, if not thousands of dollars. And so for them, it completely altered their decision, and they were better off staying on their employer plan just because of the price of the medications.
And of course, you know, when you're talking about the you know, the drug plans, you're talking about the fact that there's a whole variety of drug plans that are available if you're on for Medicare D. But you have all that information, right? You have the you know, you're connected with the computer programs and blah, blah, so you can really help people just on the drug side kind of analyze what the ideal plan is.
Yeah.
And then as you're saying but that would also allow these people coming in to compare what their best plan is on Medicare to what they're now doing with their employer plan.
I think that's the most important thing. We give them the information so that they can make that decision. Like Holly said, you could be a higher income person, you know, and have that IRMA. You'll have to pay that extra.
IRMA, what is IRMA?
IRMA is the income related monthly adjustment amount. So you could be, like Holly said, you could pay a little bit more for your Part B.
And is IRMA the one, when I think about the actual payment, I think about this, I always say this kind of, oh, what is your Medicare B payment, right? And I always think of that as kind of a standard payment per month. And I always think of it as being around like $120 or $130.
$164.90 is the standard premium for 2023.
And can you give people just an order of magnitude number, you know, once again, without going through income categories, how high that might be depending on if you're a higher income individual?
I want to say it can be over $500.
I think it could be, yeah, it could go up close to $500.
Yeah.
So once again, folks, so think about that. So it's 160 times 12, right? Is about $1,500 a month versus 500 times 12. That's 6,000. Excuse me, a year. For 500 times 12, that's $6,000 a year. That's the difference.
That would be if you're extremely high income. You know,
I think the next one up would be $258.90.
Oh, but it is a significant jump.
Yeah, but there's a range.
That's a big jump.
Yeah, there's a range.
That's a big
based
jump.
on. So one thing too is that it goes based on your taxes from the previous year. So like, or for a certain time period. So for 2023, it is actually based on, sorry, I'm going to get my chart.
Yeah.
So for 2023, it's actually based on the 2021 tax return.
Right.
So sometimes, it can go based on like a higher income, especially if now you're retired and let's say that you were working a lot in preparation of retiring. Sometimes that happens. And then people don't realize that when they were preparing for retirement, that their income that they were making and they were saving, they were trying to work extra, could potentially affect what their premium is a couple years down the road. If for some reason you are assessed a higher monthly premium, though, you could potentially appeal it to Social Security. We don't do anything with the appeals process. It has to go directly through Social Security itself. But you can always appeal that if you are assessed a higher monthly premium and then you think that that's not accurate. Because maybe let's say that you were working full time and now you're fully retired and you're only collecting Social Security. So there is a change in your income. You can always take and appeal that to Social Security and they would ultimately make the determination.
And all of that goes through the Social Security process,
Yeah.
not through like Medicare.
Not through Medicare, it goes through Social Security.
And once again, so folks, so as Holly was just saying, well, let me check my chart just to find this out. So you're not going to have that chart, right? They have that chart, and this is the government. It changes all the time. You know, I will often be doing in a different context. I'll be talking to folks about mass health, and we're trying to calculate how something is going to happen. I say, well, you know, and this is the limit to your assets. And I just give them a number and I say, don't ask me how that happens. It comes from the sky. That's the point. These things come from the federal sky, right? And they change all the time. And there's no way that you're going to be able to keep track of all that stuff, right? So you need somebody who's going to be looking at that like all the time. So I guess this relates to, I think, something that two of you have really taught me, which is this question of whether you shift to Medicare or when really needs to be looked at every year, because your income may be, your income may be changing, the benefits that you just talked about may be changing, the Part D amount may be changing, and since it's Medicare, well, yeah, it's true with everything now, you can always apply. So do you have people kind of coming in just when they're just thinking about applying for Medicare the first time, or do you have kind of regulars that?
No, we certainly have regulars, especially during the open enrollment period. So open enrollments between October 15th and December 7th. That is when people can make changes to their insurance and have their insurance reviewed for the following year. And I tell people, regardless of whether or not I saw you 2 months ago, 2 years ago, you should always have your stuff reviewed, because your needs change, your medications change, the prescription coverage on a plan can change. And so that's why we tell people to have it reviewed, because it can change pretty significantly. You know, just for example, like a tier of a medication can change from a tier 3 to a tier 4, making your prescription price jump from $50 a month to over $200 for a 1 month supply of your medication. And that's why you really do need to have it reviewed every single year.
Now, can you also kind of, Janice, can you go to this? There was something that I remember you raised when we first talked about this, and I learned something new every time I talked to you. But you had talked about the fact that from the employer's side, if this particular employee is older and is part of the employer's health insurance plan, right, that may be affecting the employer's health insurance premium that they're paying for the benefit of these workers. And so it may be that the employer benefits by having the employee shift to Medicare, right? And therefore you may want to talk to your employer to the extent that you're kind of thinking about this, right? To see if that can affect your compensation from that employer, because you may be saving your employer money by moving to Medicare. Is that a fair summary?
Yeah.
Because I'd never heard of that before. It makes perfect sense, right?
Right. Holly, can you talk about that, the employees and the numbers?
Oh, so I wouldn't say, I mean, that would really be more so for when you're looking to retire and whether or not you need to be on Medicare, not necessarily if you're just looking to take and save your employer money. It's more so the numbers in regards to when you're looking to retire.
I see.
And if you're still covered. So if you work for a smaller company, it's generally less than 20 employees, then generally Medicare is primary insurance to your employer plan. So if you work for a larger company, they are supposed to be offering the same health insurance coverage for someone who should be on Medicare as a standard employee. So that's for larger companies. So with larger companies, Medicare would be a secondary insurance to your employer. So that's why people generally delay their Medicare and they just keep their employer plan. However, if you work for a smaller company, and Medicare should be primary insurance to the employer plan, and let's say that you don't take it, your employer plan, the employer group health plan, could potentially deny claims and then request funds that were paid inappropriately. So the issue, if you delay your enrollment into Medicare and you are still working, you wouldn't be looking at issues of penalties for Medicare because you are still working, you are covered. The issue would be, okay, should you have taken this and you didn't, and now the employer plan saying, well, there should have been a primary payer prior to us, and so then it would be an issue of payment.
Wow. And once again, who would know that, until you're in that hole, until you've actually filed a claim and now you're getting bounced around in terms of who's going to be paying the bill. So the message here, folks, is in many places you will find people who are like them. You will never find people who are as good as them, or I shouldn't say that, but better than them, ever, right? But you may find some very good people in your town, right? And whom you can talk to about this. And I should also mention, as I think Janice and Holly have told me, all senior centers are for all seniors, right? All senior centers are for all seniors. So I don't want to say you want to be shopping around, but if Shine simply isn't available in your community, you certainly should be talking to other folks. This is a really important program. These senior center people are just terrific. Their point in life is to make your life better. So thank you very, very much, Janice. Thank you, Holly. I really appreciate taking some time from your day job to do this. Folks, I hope you enjoyed this. And once again, note to file. If you've got any questions, go call your senior center and talk to the Shine counselor. Thank you.
A free 3-minute online chat can give us the personalized tips we need. Visit aceyourretirement.org.
Of this presentation is, say you're in your 60s and you're trying to figure it out. So when do you want Social Security? How is that all going to work? And Rachel, because of the nature of her work, does a ton of this. So I wanted you to hear from an expert. So Rachel, tell me where you are, who you work for, how long you've been doing this.
Sure. Well, my name is Rachel Brown. I am a senior supervising attorney at Community Legal Aid, where I oversee our elder, disability, and Medicare work. Community Legal Aid is a civil legal aid program. We serve low-income and elderly residents of Central and Western Massachusetts. And essentially, we work to assure fairness for all in the justice system, protecting homes, livelihoods, health, and families. Most of our services are to people who are low income, but the folks who are 60 and older, we do not have financial restrictions, but we are focusing on those who need assistance the most and might not otherwise be able to afford representation when some sort of basic need is at stake.
So, and you folks are funded by us, right? You're funded by, it's like our tax dollars at work, right? Are helping.
Yeah, absolutely. So we receive money from the state of Massachusetts. We have a lot of federal funders as well. Our elder work is provided under the Older Americans Act. We have a lot of community partners who are very generous to us. So we certainly appreciate all the assistance that we can get so that we can help the community.
So Rachel Brown and her organization are one of the great kind of unknown jewels in the community in terms of dealing with so many of these issues. So thank you, Rachel, for taking the time to do this. So go back to my example, and I always talk about my friends Frank and Mary, their kids Peter, Paul, and Mary Jr. And I always tell people, if you're old enough to get the joke, you're old enough to be my client. So say they're Frank and Mary, and and Frank may be still working, right? Or Mary, and they're trying to figure it out. So they've got, when do they want to think about Social Security? How does Social Security work? And just talk about some different scenarios.
Absolutely. So most of the time when people think about Social Security, they're thinking about retirement benefits from the administration. And so in order to receive retirement benefits from the administration, you need to have worked long enough to be able to collect benefits or have a family member who has worked long enough so that you can collect under their record. Most people who want to collect Social Security retirement benefits are going to retire in their full retirement range, which is somewhere between 65 and 67, depending on a person's date of birth. But it is in fact possible to get retirement benefits as early as the age of 62 if you're in financial need. But please know that if you take early retirement, those benefits are going to be permanently lower than if you were to wait until your full retirement age. Another thing to keep in mind is that if you can afford to hold off on collecting retirement benefits, your benefit can be increased the longer you wait up until the age of 70.
And we're talking about not insubstantial differences, right?
Absolutely.
I know I was one of those who I turned 73 in January. I'm definitely Frank and Mary age, but I waited until I was 70 in order to take the benefits. And I remember the difference was, I remember it was something like 4% or like 8% a year, and it was the increase in the monthly payment,
It
So
can work out to be hundreds of dollars over the course of a year. So
right.
it's definitely worth getting that individualized look at whatever is going on with your potential benefit before filing for retirement benefits.
And so, how do people kind of go about figuring that out? In general, of course, we're always weighing out. On the one hand, right?
Mhm.
If you defer your benefits, then you're not getting the benefits you didn't get yet, right? And so you're losing something there. On the other hand, by deferring them, you're increasing the checks that you're going to be getting once you start. And I know, people say, well, I'm never gonna, at what point is it more beneficial to wait for that kind of bigger check? Is there a kind of a rule of thumb that you use? Or how do people do it?
So I do have to say, at Community Legal Aid, we're not able to do that evaluation for people of, is this the right time to take this benefit? But the Social Security Administration itself can answer those questions. And it is possible to sign up for what's called a My SSA account so that you can get access to what your benefit would be if you collect now. And then any Social Security office should be able to help you figure out, if you don't collect now, what your anticipated benefits are if you were to wait until later on down the line.
So the point is, the Social Security people can really help you with this. Right?
Absolutely. If you are still working too, it's important to know that the longer you work, the more you're paying into the system. So that can increase your benefits as well.
Oh, so now I'm going to give you it. So does that continue to occur? Now I'm going to give you a personal question. Does that continue to occur after you have started receiving your benefits? Does the number that you're getting continue to increase after your benefits have started?
So it can. I don't have the finer details at my fingertips,
That's okay.
but I will say the one guarantee each year is that there's almost always a cost of living increase. So at the very least, you should be seeing that increase year after year while you collect.
And so how does it work regarding spouses? Can you just talk about that a little bit?
Absolutely. Say, for example, Mary had worked all her life, but Frank had not worked a lot of his life. It might be possible for him to collect a spousal benefit based on the fact that Mary's benefit is a lot higher than Frank's. Frank could also potentially qualify for benefits if he and Mary had divorced but had been married long enough, or if Mary had passed away and he had no other access to benefits other than being a survivor.
So there were a lot of cases in which by virtue of being the spouse, you can collect the benefit. And it's funny because I just talked to some folks, and I asked about the two Social Security checks, and I asked about the wives was like $700, and the husband was like $2,000, and I was like, that's funny. It seems to me that you should be more close to 50% of what your husband is getting. and I think in this case, they had just made a mistake, that she's taking her benefit based on her income, which had been very low, as opposed to taking 50% of his, which would have been much higher. And people just have no idea.
And another thing that can weigh in there is whether or not one of them had worked and received a government pension, because there is an offset if you've done work in the past where you weren't paying into the Social Security system.
Can you talk about that a little bit, about because we often have that too. There are so many people where there are two folks, right? And maybe both of them, maybe one's a teacher or one worked in public works or whatever, right? Or one was in the private sector and one was a teacher. Can you just talk about that a little bit, and how they could figure that out, and whether Social Security will help you figure that out, or whether that's really a question that you have to go back and talk to the folks that you're getting the pension from?
So I would actually speak with both entities, the people that you're getting the pension from and the Social Security Administration, because the rules for how your benefit from the Social Security Administration will be reduced can actually be a fairly complicated calculation. So generally speaking, if a person receives some sort of retirement or disability pension from a federal, state, or local government, and so your teacher example is perfect. This is what we see most often at community legal aids. If that happens, Social Security may reduce a spouse's benefit, a widow or widower's benefit, or even your own benefit, depending on what's going on with that pension. And so we advise people to absolutely report that pension income to the Social Security Administration at the point that they're filing for benefits, because you don't want Social Security to find out later, all this time you've been receiving a pension and they didn't know about it, because it could be possible that they pay you too much in benefits and then come back to collect it later on. But if you report that pension on time to Social Security, they should be able to take that into consideration when they figure out your monthly benefits.
Right. And remember, if that's what's happened, if Social Security has overpaid you and are now trying to recoup benefits, they have an easy way of doing it. They just drop your payment, so it isn't like, oh, somehow I'm going to skate free here, right? Because, obviously folks are sometimes you're just tempted to kind of not think about it and just take the check that's coming in and figure, oh, well, this is fine, right? But then the repercussions can be severe.
And especially for the lower income folks that my office sees, the difference of 100 or 200 or your entire benefit per month can actually be life-changing.
Right.
So it's important to, number one, read those notices that come that say what they think the overpayment is and why. And number two, appeal it if you think the administration is wrong. And for those who may not be able to afford to pay it back, or afford to pay it back in the amount that the administration is collecting it, it's possible to either ask the Social Security Administration to waive collection of that overpayment, or to at least reduce how much they're taking back from your benefits each month.
Right. So the bottom line is don't just get daunted by this. Talk to somebody about it. Now, before we started, I asked you about this one question that it tends to come up here. So what about folks who are now on SSDI, on Social Security disability income, because they had a disability, they had, they couldn't work, and so how does that segue into regular Social Security?
The good news is, for people who are on Social Security disability insurance, if they remain on it until their retirement age, their benefit's going to simply switch over to retirement. There's nothing that they really need to focus on. However, one thing to pay attention to is that if you're on Social Security disability and you reach full retirement age, but you haven't yet hit the point on SSDI where you can qualify for Medicare, it's important to then sign up for Medicare once you've hit age 65.
And so if you're on SSDI and then you get to full retirement age and you flip to the regular, the Social Security Administration is going to figure that out all for you.
They're going to take care of it for you.
They're going to just send you the correct check, and the check's going to change, obviously, but they're going to send you the correct check, right?
So the Social Security disability and the retirement check should be the same amount. It's just going to switch the name of the benefit program that you're collecting under.
Oh, I didn't know that. So there isn't like a recalculation at the point at which you're going into retirement using a different formula from the one that caused your SSDI payment to occur?
So again, I'm never the one who actually calculates the benefits. I leave that up to the administration, but you can trust that whatever they are sending to you is going to be correct, assuming they have the right information of what you have paid into the system all those years.
And by the way, so for SSDI recipients, right? Can they collect early? Can they start earlier than their retirement age, like 62?
Oh, sure. I mean, Social Security disability insurance is available to basically all adult ages. And you can theoretically collect some disability benefits by virtue of your relationship to your parents.
Yeah.
Another thing I want to point out is that there's another program we haven't talked about that may come into play for people on SSDI or people on retirement benefits, which is the Supplemental Security Income Program.
Mm-hmm.
This is a poverty-based program available to people who have disabilities or who are 65 and older that the Social Security Administration offers. And so if your income from one of those programs isn't quite high enough, SSI may be able to provide an extra contribution. And for those people who are living in the Commonwealth of Massachusetts, there's a state program called the State Supplement Program that will give an additional SSI payment for people who are on SSI. So it's really important to ask at the Social Security Administration, is it possible for me to qualify for another benefit? And Social Security will look into all the benefits that you should apply for.
And would that include the possible state benefit?
Yes, if a person
Oh, that's
qualifies for SSI or is just over the income for SSI,
Yeah.
they'll still send your information over to the state, and then the state will start calculating your state supplement program benefit.
That's great. That's great. So I guess, you know, the bottom line here, the takeaway here is check it out with the Social Security Administration, right? They are, and in my experience, they have the most friendly bureaucracy I have ever met. You know, you go to their office, you know, people are really well informed, really well trained, and they're really trying to help you out. They're not like trying to beat you away, you know. And if you've got any questions, talk to Rachel Brown. Rachel, can you just give us your contact information if people just had a question?
Sure. So I'll give Community Legal Aid's general information.
That would be great. Yeah.
Our easiest phone number is 855-252-5342, which is 855 CLA Legal.
Yeah.
And we also have a website, communitylegal.org. It's possible to apply online straight through that website or through the phone number. And we have a lot of information on our website about the various services we can provide. So we invite people to contact us.
Rachel Brown, on behalf of myself, Frank and Mary, and all of the people who are watching, I really, really appreciate you taking the time. I hope this doesn't result in you're getting buried with more work. But I think it's really helpful for a whole lot of people. So thank you.
It's been a pleasure to chat with you.
Thanks.
Part-time job, full-time hustle, all-time Shiro to all of us. It's time for you, our Shiro, to stretch for the stars. A free online chat can give you the personalized tips you need to start boosting your retirement savings today. Visit aceyourretirement.org.